So after careful consideration, I'm ranking Meta Platforms as the best stock to buy in 2026. For the rest of this video, I'll elaborate on my thinking, reasoning, and data behind that ranking of number one for Meta Platforms in 2026. I'm going to start with the company's revenue growth rate looking back over the previous decade. Meta has generated considerably strong revenue growth, compounded annual growth rate at 28%. Its revenues have grown from 17.9 billion in 2015 to 165 billion in the most recent trailing 12-month period. On top of that fact, Meta Platforms operates in the social media industry, which generates most of its revenue from advertising. As you've heard me discuss, I think the advertising industry is the only industry where I can forecast growth into infinity. That means I think the advertising industry will continue generating revenue growth between now and infinity. That's because I see the advertising industry as a meaningful component, in fact, a critical component for worldwide economies, not just in the United States. Advertising supports so many industries. Worldwide economies would be a fraction of the level of where we're at today if it weren't for advertising. Advertising supports so much sales in so many different categories. I don't think there will be anything that will change that factor. You need to market, you need to advertise in order to support your business. You need to let customers know of the existence of your products and services. Otherwise, how will they find your products and services amid all of the different websites, apps, social media accounts, store locations that are available worldwide? On top of that, Meta Platforms operates in the user-generated content business segment. That's another category I find to be incredibly lucrative. People like you and me create content on Meta's platforms, and the company generates revenue from the engagement created by folks like you and me. And so I like this business model. I like the industry it operates inside, and Meta has demonstrated significant growth in these industries. And it's not just revenue growth. Meta has generated growth with strong profitability. Now, in my book, I talk about the customer value proposition as being one of the 6 most important steps I evaluate when making an investing decision. Meta Platforms offers an incredible customer value proposition. It scores 100 out of 100 in my ranking. Why is that? Well, it offers you a free product, right? The social media apps are free. They work really good. They are working 99.9% of the time. There's little lag when you're experiencing the platforms. It's a great customer value. Solid app with billions of people on the platform. Almost everyone you know is on one of Meta's platforms, so you can go on and engage with your friends, family, coworkers, etc. on its family of apps. But I also talk about in my book that it's really easy to offer customers a great value if you're willing to lose money on the bottom line, right? That's an easy thing. I can create a product that cost me $1,000 to make and sell it to you for $10, and you would love my product. You would love my business. You would tell everyone about the great value. But my business wouldn't be around for very long because I would be losing so much money on the bottom line. I'd run out of money and I would have to close up shop. What's more difficult is to offer a great customer value and at the same time operate a sustainable business with sustainable profitability. Meta Platforms does that. In fact, it generates very lucrative profitability, not just sustainable profitability. In the most recent trailing 12-month period, the company's returns on invested capital exceeded 40%. It's approaching 41%. And this is an incredibly important factor, and more so in recent years because Meta is spending so much money developing artificial intelligence capabilities. That's the biggest risk right now that investors foresee with Meta stock. That's why it's trading at what I believe is a relatively cheap valuation, is because investors are concerned that Meta is spending too much money. But in my opinion, I give the management team the benefit of the doubt. I give the management team a little more rope because they've demonstrated such an effective ability to allocate capital in the management team's history, right? Mark Zuckerberg has been the CEO since its founding, and he's demonstrated an excellent ability to allocate capital. Now, it hasn't been 100%, right? Not all of his decisions have been effective, the metaverse being one of which that wasn't very effective. And there's been other examples. But overall, Meta and its management team have been effective allocators of capital. And when a management team has a good reputation and has built that reputation over time, demonstrating effective decision making that results in good profits and cash flow, I give them the benefit of the doubt. When they make big investing decisions or when they make big investing plans, I'm excited about that. I'm happy about that because they've demonstrated an effective ability to allocate capital. I'd rather have them spend the cash they have on the balance sheet in products and services that are likely to generate profits and cash flow rather than just letting that cash sit on the balance sheet, putting it in a savings account that are generating 3, 4, 5% rates of return. I'd rather have them invest that capital because on average, over the previous decade, they've earned a return on invested capital that exceeds their weighted average cost of capital. And in fact, the average return on invested capital over the previous decade is above 30%. So when a company has this kind of reputation and this kind of ability, I want them to do more of this, right? And I'll use a couple of sports examples. If you watch the NBA, if you watch basketball, and you've seen Stephen Curry shoot a basketball, anytime he touches the basketball, you want him to shoot that basketball. If you're a Golden State Warriors fan, you want Stephen Curry shooting three-pointers. If he shoots 15 of them, you want him to shoot 20, 25, 30. As many three-pointers as he gets the opportunity to shoot, you want him to shoot those three-pointers. If you're a baseball fan, and I'm a Dodgers fan, if the game's on the line, who do you want coming up to the plate to bat? You want Shohei Ohtani up there, right? Every single time. Even though he strikes out so often, even though he gets out 70% of the time, you still want him up there swinging the baseball bat. That's what he's good at. That's what you want him to do. Now, it's similar to this example with business, with the management team. This is what they're good at. This is what Meta's management team is good at, taking money, investing it in products and services that generates profits and cash flow. And the more opportunities they see to do that, the more you want them to do that because they've done that effectively, right? The reason why Steph Curry is so good at shooting the three-point shot is because he's practiced and because he doesn't take wild shots. He knows which shots to take. The shot selection has been great. Similarly, with a business and a management team, their selection has been good. They've allocated capital effectively. They've had some misses, right? Nobody's 100%. But you look at their percentages over the decade and over their history, they've been effective. So we looked at the return on invested capital. I also wanted to share with you the return on assets. Now, this takes into account all of the asset on the company's balance sheet, not just those assets that are invested. And with Meta Platforms, it's held on to a lot of cash on the balance sheet. That's been one of my criticisms for these large tech stocks in the recent past before all of this investment in AI. One of my criticisms for a lot of these companies has been that they just let this cash sit on the balance sheet. And I was not happy about that because I can take that cash and put it in a savings account myself. Why would I give and invest money into a company that's going to take my money and just put it into a bank account anyways, right? I didn't see that as an effective allocation of capital. I'd rather see them find opportunities to invest. And that's what I've been talking about with this AI is that it's a opportunity for these large tech companies to use a lot of the cash that they've built up. They've got tens of billions of dollars of cash, and you want them to use that. And with AI, they found an opportunity to allocate that capital that's going to generate and is expected to generate a good return on that investment. And so their return on investment has fluctuated between, let's say, 13 and 24% over the previous decade. And it's been on the rise. And with their assets increasing, over the previous few years, their total assets on the balance sheet have increased from 186 billion up to 276 billion. Now, some of that increase in assets has been from the company generating cash flow, generating profits through organic operations. The core business is so profitable that it generates tens of billions of dollars of cash flow every quarter and every year. And then on top of that, they're also borrowing money at attractive interest rates because Meta Platforms has a great credit rating, investment grade credit rating, and can borrow money at relatively low interest rates. And so they've been able to build their asset base from 186 billion to 276 billion. But even more importantly, their asset base is now more invested in assets that are generating cash flow. Before, more of their assets were just sitting in the bank account in cash, generating 3, 4, or 5% rates of return. Now, more of those assets are invested in data centers that are optimized for artificial intelligence that the business is using to generate profits and cash flow, right? These data centers are helping make their social media platforms more effective at generating capital. They're making their advertising platform more effective. They're using the recommendation system more effectively to surface content that creates better engagement from its users, which then gets those users to stay on the platform for longer and engage with the platform more frequently. It also allows advertisers to show more relevant advertisements that generate a better return on those advertisements, which then increases the demand from advertisers to spend more money on those ads because they're getting a good return on investment. And I'll share with you those details as well. So I'm going to share with you some more detailed data, and I'm getting this data from Fiscal AI. They're pretty great at generating this kind of segment-specific information. So Meta Platforms' family daily active people is still increasing, and it's increasing at an increasing rate. So between March and June of 2025, they added 50 million daily active people to the platform, to all of the platform, right? They have Meta Platforms, WhatsApp, Instagram, and Threads more recently. So they're still adding, 50 million people from March to June. And then from June to September, they added 60 million people. So from 50 million growth to 60 million growth, right? So now they have 3.54 billion people that are on the platform every day. That's roughly half the planet, especially if you exclude China, because the company doesn't have access to China, and it still has 3.5 billion, 3.54 billion people, and it's still adding new accounts, right? Some people have two accounts, some people have a personal account and a business account. Some people have a personal account, a business account, and an account for their pets. And so they keep growing. They keep adding new accounts to the platform, and accounts create engagement. Importantly, they're showing more advertisements on the platform, right? In the quarter which ended September of 2025, there were 8% more advertisements shown in the US and Canada. And the reason I selected US and Canada, because that's the most lucrative region. That's the region that generates the highest average revenue per advertisement. That number is increasing. Worldwide, the number of advertisements shown increased by 14% compared to the same quarter last year, and that figure is accelerating. It increased by 5% in the quarter that ended March, up to 11% in the quarter that ended June, and now up to 14% in the quarter that ended September of 2025. That's an indication that people are spending more time on the platform because they're getting shown more advertisements. It's also because there's more people on the platform, right? We saw 60 million people were added between March and June, and then 50 million people between March and June, and then another 60 million between June and September. So there's an extra 110 million accounts on the platform from March to September. And so those are more people, more engagement, more advertisements being shown. And of course, that's how the company makes money. But even more impressive is not only are they showing more advertisements, but the price per advertisement is increasing. A couple of years ago, when Meta platforms increased the number of ad impressions, the price per impression decreased. But this time around, as their advertisements shown are increasing, the price per advertisement is also increasing. So they're getting a benefit from more advertisement shown, and then each ad is generating a higher price. In the most recent quarter, that was 13% more compared to the same quarter last year. The quarter that ended June was 11% more. The quarter that ended March was 14% more. That's a powerful revenue growth driver when you're showing more ads and it's generating more price per ads. And I love that this is under Meta's control. What I mean by that is if it wanted, it can show you more advertisements per minute engaged on the platform, right? If it was willing to monetize the platform more aggressively, it could show you more ads every time you're on the platform. Of course, that would take away from the user experience, and that would make you less likely to open the app and slowly erode that customer value proposition. But it could do it if it wanted to temporarily boost the number of advertisements shown to monetize a little bit more aggressively. It can do that. It's under its control. And given how much more, uh, I want to say, how much more usage Meta already generates compared to other social media platforms, it has the power to do that without losing too many people and without losing too much engagement. Because second place, if you look at Reddit, Pinterest, uh, X, Meta generates the most engagement and generates the highest average revenue per user, has the most social media accounts. So it has room to monetize more aggressively if it wanted to. It has that power uh, dormant that it can capture whenever it wants to. So we looked at several of the profitability factors, but I mean, the company, out of every dollar of sales, it generates operating cash flow of 55%. So every dollar of sales generates about 56 cents in cash flow. That's an incredibly lucrative rate. It's among the best of any of the companies that I'm following. A OCF to sales ratio at 55%. And this is likely to increase further as the company has invested in these data centers optimized for AI. That increases the assets, which increases the cash flow a company generates because the operating cash flow doesn't incorporate the capital expenditure that's going into it. That capital expenditure is categorized in a different area in the cash flow statement. So it takes away from the company's overall free cash flow, but the operating cash flow increases because you're utilizing more assets and it generates more cash flow. This figure, I expect, will continue increasing in the near term as it utilizes these data centers to make engagement more exciting and enhances engagement and also increases the effectiveness of advertising, which generates more demand from advertisers and marketers worldwide. So I've shown you all the excellent performance metrics from Meta platforms, and the valuation is very attractive as well. It's trading at a forward PE of 22. Now, you'll rarely find a company that's generating revenue growth in the double digits, approaching 20%, increasing profitability, returns on invested capital that are multiples of the company's weighted average cost of capital, earnings per share growth in the double digits, operating cash flow to sales ratio among the best in the world at over 50%, approaching 60%. You'll rarely find in fact, I don't think you can find another business like that that's trading at valuations this cheap. And the primary reason why it's trading at a valuation this cheap is because it's investments in artificial intelligence. Investors are concerned that it's spending and allocating too much capital to that category. And I tend to agree that this is a risk from the investor perspective, and investors are still a little bit traumatized from the former aggressive investing plan from Meta platforms with the metaverse. So that's another reason why Meta stock is trading at a lower valuation is because investors are saying to themselves, is this the metaverse all over again? Because we don't want to take part in that. We didn't like that outcome. And so they're a little bit freaked out by it. And that's understandable. I understand that concern. But at the same time, I like the fact that the previous big increase in investment, the CEO, when he noticed that the investing community was not happy about that and it saw its stock price declining, it pivoted and it said, okay, we'll take our foot off the gas pedal here with the metaverse and we'll kind of slow down. And it can do a similar thing here with artificial intelligence. If it starts to realize that the returns are not as attractive as it initially thought, it can take the foot off the gas pedal and alleviate some of that concern. It's under Meta's control. This isn't something that the competition has placed upon Meta platforms. It's not competition that's innovated more aggressively than Meta, and now Meta is trying to play catch up. It's Meta itself anticipating a big opportunity and wanting to be a leader in that big opportunity. And it opens up some optionality for the company in an area. Now, this might be a small probability, but I think there's an opening for Meta to capture some of the hardware segment sales in consumer electronics. I think Apple has created an opening, and I like that Meta is taking a shot at this category because that can be a huge multi-$100 billion opportunity for Meta to capture. And just some of the reasons why I say that Apple has created an opportunity is because Apple has underinvested in the development of its hardware that it's offering consumers, especially in the smartphone segment. The iPhone has seen very little improvement over the previous 5 and 10-year periods. It's been a bunch of incremental improvements. A little bit better camera, a little bit better battery, a little bit better screen, a little bit better performance, and that's about it. Furthermore, developers are upset with Apple at the hefty fees that it charges 30% on the App Store. And so developers are also open to a new player coming into the hardware segment, taking market share away from Apple, reducing Apple's dominance and near monopoly in the category. So there is an opening there. And I think the AI investments are geared towards not just the categories we discussed so far in this video, but also creates an opportunity for Meta to capitalize on that hardware, consumer hardware. Small probability of success there for Meta, given the dominant position Apple holds. But if it should be successful, the payoff is huge. Small probability of success with a high payoff if successful. So I also looked at Meta valuation using my proprietary discounted cash flow model, which, by the way, if you want access to all of my spreadsheets that have these discounted cash flow valuations, you can get access to that if you join my channel as a member at the investor tier or above. So I updated my Meta calculation today. There's a few changes. I decreased my expectations on free cash flow from Meta in the next 2 years, in 2026 and 2027, but I increased the growth rate of expected free cash flow between 2028 and beyond, because these investments in AI are likely to weigh on Meta's free cash flow here in 2026 and again in 2027. But I think after the bulk of those investments are completed, there will be lower investment in artificial intelligence from Meta from 2028 and beyond, when it will start reaping the benefits of the investments it's made in 2023, 2024, 2025, and 2026. So my intrinsic value per share actually increased for Meta. It was around $780 per share. And this morning I updated these figures and it increased to $867 per share. That's a significant increase and a significant undervaluation, given that its market price is $649 per share. So there's upside there for the share price to approach the intrinsic value per share I calculated for this business. And so for all those reasons, I ranked Meta Platforms as the top stock to buy here in 2026. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.